Peer-to-peer lending, like all investments, bears some risk, and with that risk comes the possibility of an expected return. Peer-to-peer lending, commonly known as P2P lending, is a type of lending in which borrowers can obtain a loan from a person or firm that is investing in those borrowers. In other words, loan funds are provided by individual investors rather than the lender. If you don't have good credit or aren't eligible for a typical personal loan, you can check into peer-to-peer lending platforms to get your loan funded. Peer-to-peer lending connects investors, both individuals and businesses, with those that need money. Traditional personal loans are provided by institutions such as banks, credit unions, and online lenders. Peer-to-peer lending occurs when you borrow money from a person or company that has invested in your loan. If you're considering getting a personal loan through a peer-to-peer marketplace, be sure you first understand the benefits and drawbacks. Pros: fair credit is granted. Borrowers with credit scores as low as 600 are permitted in some peer-to-peer marketplaces. This is terrific news if you don't have a great credit score or any credit at all, and cannot obtain a loan through traditional means. Rapid funding procedure. As with many online lenders, you'll complete your application in a matter of minutes, and if approved, you'll receive your funds within a couple of days. Some banks and credit unions may demand in-person applications or take much longer to fund your loan. Cons: you might have to pay more fees. Peer-to-peer lenders typically impose origination fees ranging from 1 to 8% of the loan amount. All do not charge this fee. However, it would be best if you researched all prices before applying. You would have to pay a higher interest rate. You may have a higher interest rate with a peer-to-peer marketplace than you would with a traditional lender. Your credit score also determines your interest rate. The higher your rate, the lower your score. Before applying, shop around for the best peer-to-peer loan rates. Just because peer-to-peer lending isn't risk-free doesn't mean it's dangerous. We believe that understanding the risks offers you an advantage. You will be able to earn returns that exceed the risk you assume by supporting a portion of a loan. And that is what peer-to-peer lending as an investment is. It's a crowd-funded loan, and you're investing in a part of it to earn interest. We'll look at the system-wide hazards connected with this type of investment. These are risks to be aware of regardless of the platforms on which you invest your money. The risk of loan default and late debt repayments. You're probably aware that peer-to-peer lending is a debt-based venture in which investors lend money to individuals or businesses. Interest rates provide you with returns. Borrower risk is thus the most significant risk in peer-to-peer lending. Borrower risk is the risk that the borrower may default on the loan, resulting in the loss of your investment as well as any potential income collected. Fortunately, we can control this risk without having to become credit analysts ourselves. The majority of this risk is linked to the same platform you choose for investment and how they protect your money. Some platforms, for example, provide loans secured by underlying properties such as real estate. In late repayments or loan defaults, investors can sell the collateral, while other platforms offer buyback and payment assurances. This means that the first stage in managing borrower risk, what occurs when the borrower stops paying, varies by platform. Whatever amount of risk you're willing to accept, you must understand what platforms will and will not mitigate and compensate for the dangers associated with P2P investing. The risk of an unsuccessful loan originator going bust. Many EU-based platforms serve only as aggregators, relying on professional lending organizations known as loan originators. Instead of outlets selling loans, loan originators select borrowers to send to the P2P platform. This implies that instead of directly financing the forum, you are lending to the loan originator who will then transfer the funds to the borrower. The same is valid for debt repayment, in which the borrower pays the loan originator who then pays the lender via the platform. In other words, borrowing occurs outside of the peer-to-peer lending network under this business model. The loan originators sell the loan to the platform's registered investors. With the vital position they play in the financing process, you can understand how originator risk could affect you. Using loan originators does introduce an additional risk that would not have existed if the platform had not used them. One of the benefits of this peer-to-peer lending business model is that it allows P2P platforms to focus solely on administrative responsibilities and collecting lenders or investors. When opposed to a scenario in which the venue would have to manage every step of the procedure, this frees up time to enable loans more quickly. The risk of the P2P platform itself going bankrupt. P2P platforms are much like any other businesses looking to make a profit. If they don't have enough money, they may go out of business. This is known as platform risk. It is asking yourself the question, what is the danger that the peer-to-peer platform will fail? In this situation, the platform will be in charge of collecting any outstanding debt from its borrowers and repaying any excellent investments. However, this could take a long time. Some media use backup loan servicers. A loan servicer is a corporation that maintains the loan agreement for the borrower to pay back. They keep accounts for payments and collections and payouts to lenders if the platform cannot, and they can't if they're out of business. Because the platform serves as the primary loan servicer, this third-party entity is referred to as a backup loan servicer. All mortgage businesses use backup loan servicers, and P2P platforms in the United States utilize a backup loan servicer such as Vervent. After all, a platform failure should not exempt a borrower from fulfilling their duties and repaying the debt. Risk management and countermeasures in P2P lending. Diversification is the most effective way to manage the risks of peer-to-peer lending. Aside from diversifying your assets in P2P lending, your investment portfolio should also include other sorts of investments. Unless you have a very high risk tolerance profile and are a true specialist in discovering suitable loans for investment, you should only have a portion of your portfolio comprised of P2P lending. Suppose the P2P lending platform through which you are investing is genuinely an aggregator of loan originators. In that case, it is critical that you thoroughly examine the financials of each loan originator before you throw your money at them. If the loan source goes bankrupt, depending on the guarantees and the protections provided, the situation can quickly deteriorate. Again, you could lose the majority, if not all, of your invested funds. The final risk management tip we'll go over here is underwriting. Underwriting is the process of approving credit. What criteria do you use to pick who to support? What distinguishes one borrower from another? You can considerably reduce your risk by using P2P lending sites that are picky about who they lend to before accepting them. Even consumers with excellent credit may find themselves unable to repay their loans. As investors and platforms, we can both considerably minimize the possibility of loan default or late debt repayments, but the risk will never be zero. We examined the critical hazards and remedies to comprehend and answer the question, is peer-to-peer lending safe? Yes, but only if you conduct the essential research and take the safeguards we've discussed here. There are numerous methods that investors and platforms may take to preserve our returns and promote safety. We're attempting to determine how safe peer-to-peer lending is and how we can make it safer. Preparation and planning before investing will make your P2P investing safer. Platforms provide assurances and protections to let investors feel more at ease about lending their money. These safeguards will act as a type of insurance for investors, protecting them in the event of a missed loan repayment or even a loan default, and assuring that they do not lose all of their money. Other risk mitigation strategies used in P2P lending come from the investors themselves. These risk controls are the most critical, since any of us can implement them and failing to do so is a mistake. Before investing, diversify your investment portfolio and thoroughly investigate peer-to-peer platforms and loan originators. Use only those who are open and concerned about investment protection. You can find P2P platforms that share data with the market and read through many different P2P lending platform reviews on P2P market data, all of which are written to make the peer-to-peer market more transparent and safer for you as an investor. Make sure to give this video a thumbs up and comment your thoughts in the comment section below.